Good morning from cloudy and cool Chicago, where we are ecstatic over last night's incredible fourth quarter comeback victory by our beloved Chicago Bears over our hated rivals, the Green Bay Packers. Note the celebratory hat. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today's date is Sunday, January the 11th, 2025. In today's podcast, our focus is on the benchmark S&P 500, which finished Friday's session at 69.66, which was up 108 points or 1.6% for the week. This on the heels of a 964 point, 16.4% gain in 2025. SPX has now risen by a very stout 44% since April the 7th of last year. SPX actually broke out higher last week from its October sideways distribution rectangular pattern, which suggests that the previous April advance is resuming and targets a potential additional 5% rise to 7,300. However, there's a lot of obstacles and potential potholes between here and there, and quite a bit of that is strategic weakening that we have seen emerge in a lot of different relationships between various indexes over the past few weeks. We're going to look at this landscape today and show you how we're trying to navigate it. Before we get started, let me give you some information about us. Asbury Research is a registered investment advisor. We're an RIA, and we've been providing investment research to both individuals and professional money managers since 2005, which makes this our 21st year in business. Most recently, we have created 4 model portfolios using our own in-house models like the correction protection model, or CPM as we call it, and our SEAF model, our sector rotation model, as building blocks for managed accounts. These portfolios have been trading in real time for the past 18 months by both individual investors and also other RIAs and various money managers. For those that are interested in our research, we have 2 levels of research service available. We have our Asbury Premium for more serious investors. This is the service we launched our business with in 2005. It includes the latest updates on all of our models and some one-on-one instruction that we typically do via Zoom on how to implement our models and strategies into your own portfolio. We also have our entry-level Substack newsletter, which I'm going to go to now. And Substack is relatively new. I think maybe 2 years. Doesn't include any of our trading models, but offers selected curated reports and models from our a specific model that we built strictly for the Substack. You get about 3 reports a week, and that includes a weekly 8 or 9 chart summation of what we see is going on in the markets and what you should be paying attention to. There's also a free version of this. So if you like our videos, you like our approach to markets, I strongly suggest that you sign up for the free version. It's kind of a no-brainer. You're going to get 1 piece of research every week. So if you're interested in us and want to learn more about us, or maybe you're tracking us on our YouTube channel, this is just another item that I think would help you to get to know us better. If you're interested in a managed account rather than research, individual investors, financial advisors, and RIAs can access our 4 model portfolios, which are Asbury Aggressive, Asbury Balanced, Asbury Conservative, and Asbury Ultra Conservative via managed accounts, or SMAs, that are available through Charles Schwab. If you're an individual investor and would like to learn about these, reach out to us via the contact tab at asburyresearch.com, which is right here up the corner. Financial advisors, RIAs, and other portfolio managers can also access our 4 model portfolios through Schwab Institutional or via a TAMP. A TAMP is a turnkey asset management platform. Again, use the contact tab. Let us know what you're interested in, and we will contact you and probably set up a Zoom meeting. All right, enough advertisements. Let's get to the good stuff. Let's go into the research center and take a look at our Asbury 6. This is updated through Friday. The A6 is a daily data-driven gauge of the U.S. stock market's real internal health, according to 6 diverse market metrics, which we selected and put together as kind of a team via quantitative backtesting. Think of the A6 as a daily EKG for the stock market. It's very sensitive, and what the purpose of this is it's very difficult nowadays to look at the S&P 500 and maybe a stochastic or some traditional indicator and get a valid idea of what the condition of the market is. So what we did is we took all of the tactical indicators that I've been using throughout my career, and we started to back test them in sets of 3, sets of 5. We were looking to put together a group of these that would kind of give us an under the hood EKG-like, how's that for mixing metaphors, way to look at the market internally, so we're not chasing the tail of the S&P 500 as it's up 100 today and down 100 tomorrow. Think of the A6. Let's go here. The A6 is all green, so that means A6 is positive. The market's internally healthy. 4 or more green cells here, constituent metrics, would indicate that there's a positive bias to the A6. It's updated every day about 2 hours after the close. 4 or more red would need to show up on the daily graphic, again, which is updated every day, to indicate that the market is weakened and it's vulnerable to further losses. The market is vulnerable to starting a correction. As long as the A6 remains 4 or more green, it's likely to remain steady to higher in the weeks ahead. And again, a shift to 4 or more red constituents indicates the market's weakening, and that's when you should start considering what to do if we go into a corrective period in terms of what to protect and how to shift your portfolio around. The next thing we're going to look at is our CEF model. So we're going back to the research center. CEF is our dynamic alternative to that part of your portfolio that stays in the market all the time. Most people, especially managers, managers can't go 100% cash. Most managers can't go to 100% cash. They may be able to go 20%, but that's about it. So most individuals, most money managers, either by design or because they have to, or either because they want to or they have to, keep some money in cash. Most of the time that goes into something that's going to be vanilla, like the S&P 1500 or something like that, or some kind of a broad index. What this does is follows the top, it basically puts us into the places where the money is going. What this does is we built an algorithm that tracks the velocity of money moving around these 11 sector spiders, which if you put them together, it's the S&P 500. And they're looked at in 3 different time frames: trading, tactical, and strategic, which is a week, a month, and a quarter. And then it's rebalanced once a week on the weekend. And what it shows here for the past week is that the fastest money going in last week was going in healthcare. The fastest money coming out and going elsewhere last week was in technology. So we have from 1 through 11 for the 11 sector spiders. Then we add up the scores. Healthcare was number 1 in trading, number 3 in tactical, and number 1 in strategic. So that's a very high score of 5. Industrials also had a high score of 5. We've been industrials now for maybe close to 2 months, and that has moved higher while also outperforming the S&P 500. The theory of this is we're going where the money is going. If the money changes and goes somewhere else, we go with it. We measure it in 3 different time periods. So CEF is currently overweight, as I said, healthcare, industrials, and financials, XLV, XLI, and XLF. Again, always fully invested in the market. Since inception in mid-2018, CEF has significantly outperformed the S&P 500 on an annualized basis, but with the lower maximum drawdown, about 5% lower maximum drawdown throughout that period, which is about 7.5 years. Why drawdowns are so important? Let's change looks here and have a look at why we think drawdowns are so important. Let's look at COVID. During COVID, which was the early part of 2020, the S&P drew down 34%. So let's look at this as an example. If the S&P draws down 30%, it needs to make 43% the other way in order to get back to where you were up at the top. For somebody who's 35, it doesn't matter that much because you have a lot of time. It's like football. During the first quarter, teams can take some chances. They can throw the ball downfield. They can handle the ball in the backfield. They could do some tricky stuff because they have time to recover. Once you're in the fourth quarter, the game changes. Time becomes an element. So if you have a lead going into the fourth quarter, you want to keep it. You give the ball to your big halfback, and you try to score if you can, but you don't take any chances. You don't want any turnovers late in the game because the clock is ticking. I think that's very synonymous to I'm in my 60s. When you get into your 60s, you play the game differently. One last item on the CEF model as we change views again. CEF has posted a positive annual return every year since 2018. That's hard to do. So the next thing that we're going to shift to here is one of the many reports that we produce is called Keys to This Week. It's part of the premium service, and there's a similar report to this that's also in the paid version of Substack. But there's 4 charts that I want to talk about today. And the first one is just a look at the S&P 500, where we are, where support is, what to pay attention to. So this sideways move that we've had here since October, it's a distribution pattern. Typically, after you have a long move higher, where there's a lot of buying going on and there's a lot of accumulation of positions, once the market hits the stopping point, you get a lot of churn. There's a lot of people that are taking profits. Maybe there's some new money, but the market pauses there to kind of digest those gains rather. So what happened earlier in the year, actually right here, when the S&P 500 broke out in late June to fresh highs, that gave us a target of 69.50. We got to 69.20 here. We're breaking out above it. As long as we could stay above the 69.20 area, technical analysis tells us our next measuring objective is 7,300. If we fail from there, that's a problem. That means it's kind of a false breakout. The market tried to test the waters and go higher and pulled back. If we go through this 68.24 to 68.18 area, that's when the problem becomes a little more tangible. And depending on what's happening in the Asbury 6, the Asbury 6 goes back to 4 or more red. Now we're a little more problematic. So that's chart 1. Chart 4, and there's a total of 9 charts here. We're going to go through 4 of them today. Chart 4. The Magnificent 7 has been a primary driver in the strength in the broad market over the past year. There's an ETF for that, just like there is for almost anything else you can think of. So this is MAGS. This is the ETF that tracks the MAG 7. It's been outperforming. It had been outperforming on a 63-day quarterly basis since May the 9th. On November the 17th, it started to stall. That was about a month after we peaked. Actually, about 2 weeks after we peaked at 69.20 in the S&P 500. Look what it's doing now. It is now underperforming on a 63-day quarterly basis. The longer that this stays true, the more likely that the S&P 500 is going to run out of gas up here somewhere unless it could find a replacement for that. Semiconductors have showed some strength, and so far they have been able to replace the mojo, if you will, of the mag's outperformance. But we're going to be watching that one really closely. So Asbury 6, the EKG for the market is positive, but we're losing our leadership. This is another one I wanted to show you. This is the OEX. This is the S&P 100. Historically, when we're in a healthy bull market, the 100 outperforms the S&P 500. You could see that here. We broke out in the OEX above the 200-day moving average on May the 12th. On May the 13th, OEX started outperforming SPX. That remained true until December the 11th. Now it's underperforming. So this is another market relationship that we watch closely to see, even though the A6 is strong now and it's showing you tactically, it's clicking on all 6 cylinders. There's some strategic weakness here that we're seeing in market relationships, and that's just another one. Seasonality. Seasonality for me is tertiary. I don't put a trade on because of seasonality. However, I want to know what it's doing, because when seasonality overlaps with what we see that's going on real time in the market, that's when you could really get some more accelerated moves. So seasonally, this is the S&P 500, the 13 weeks of the first quarter in the S&P 500, going all the way back to 1957 through the end of the year. So January 5th is the strongest day of the entire first quarter, according to seasonality. And you can see it bottoms out, kind of steadily moves downward, bottoms out at the end of February, early part of March, and then March starts a recovery that goes into April. So should we fail here, and we have not yet, as long as that Asbury 6 remains 4 or more green, and we stay above 69.20 in the S&P, we're not fighting this. Let the market tell us when it's ready. But there are some internal cracks in the foundation here that are that we're starting to pay attention to. Now let's look at our trade ideas. Let's move back over here. So our premium research product has a lot of different models and information to satisfy different types of traders. There's a lot of people that like the short-term trading, and this is what our Asbury ETF trade ideas are for. So what we do is we scan 6,600 ETFs every morning at 5 o'clock in the morning to look for certain criteria that we have that have to do with the positive price trend. It has to do with relative outperformance versus the S&P. Because in my world, why buy something if it's not outperforming the S&P 500? The S&P 500 is easy. You buy SPY. Now you have open-ended downside, but again, in our world, I want something that's outperforming the benchmark S&P 500. The third thing we do quantitatively is we look for expanding assets in that ETF. The fourth thing is the only subjective one, and that is me taking a look at that list that gets spit out for us every morning and find those ETFs that have the best risk-reward opportunity. It might be something that just broke a trend line or made a fresh high, or maybe is sitting on a support level. But these are the 4 criteria that we use to buy an ETF. The ETFs that we're looking at right now, or that we have an open idea in them, we have biotech, XBI, which is relatively recent, 1223, IWM, XTL, and the oldest one is Ring. Ring, since 11/26, right before Thanksgiving. So far, that has risen by 14%, and it is outperforming the S&P SPY by 12%. And this is our soft stop at 75. Note down here that we had previously been in gold miners as of August the 6th. We kept the position until 10/21 of last year. And in that particular idea, we captured 31% outright while outperforming the S&P 500 also by 31%. So this is kind of what we're doing. Keep an eye on Ring. I still think it's got some legs as long as we hold our stops, and our stops follow the market up. As we make more money in the particular trade, we want to make sure we don't give it all back. So we're very proactive in ratcheting up our soft stops as our ideas start to make money. Next, all of these things that we showed you today, Asbury 6, CPM. We didn't talk about CPM today, actually, but that's a correction protection model, and that's a part of a lot of our model portfolios. But everything that I showed you today are all a part of Asbury Research's premium research service. Contact us here via the contact tab to request information about service details and pricing. Next, let's take a quick look at our Substack. So we're going to go back to Substack. We were here a little bit earlier. One of the features of Substack is our sort report. Sort report tells us what parts of the global market have positive trends, are outperforming their benchmarks, and have positive asset flows, which means that new money is coming in and pushing the price of that asset higher. This is a very low-cost way to make better investment decisions based on data, not on opinions or economic forecasts. Forecasting for us is a euphemism for guessing. I want to see the numbers. So we're basically following the money. Let's look at this a little bit closer before we finish up. What this does is it gives us a bunch of different asset classes. I think there's 10 here. We got gold, emerging markets, global equities, ex-US, technology, interest rates, crypto, small cap commodities, crude oil, and the dollar. A lot of assets kind of going through a funnel. What this is telling us right now is emerging markets, global equities, ex-US, without the US, US tech, and US tech, those four. Those are clicking on all three cylinders, so to speak. They have met our criteria in trend, relative performance, and money flows. How do you use that? When you're looking during the week at where there's a bajillion markets out there, what do I want to buy? Where do I want to look for value? Where do I want to look for opportunity? This is a giant sorter that tells you at least start by looking at gold. That means ETFs, that means gold stocks. By looking at emerging markets, by looking at EEM, that's the ETF for emerging markets. It's a quantitative way to go through a lot of data and a lot of ETFs and find what is working, and then you could drill down from there. So let's move back to asburyresearch.com, and let me make a couple of quick notes. Jack and I presented our 12th annual investment outlook for Fidelity Investments last Wednesday, Jan the 7th. We have a PDF on that. If you would like a copy of that, that's the slide deck from the hour-long presentation. Again, go to the contact tab here. There's a little text box near the bottom. All you need to do is type in Fidelity slide deck, get that back to us, and we will email that to you. Secondly, my next monthly interview that I do for the Schwab Network is going to be this upcoming Wednesday, Jan 14th. They're usually at about 9:15 a.m. Chicago time, so you can catch me there if you're interested. Finally, a little bit of advertising if we can. My sons, Jack and Brett, and myself will be representing Asbury Research in the 25th annual Polar Plunge fundraiser to help raise money for Chicago families that have had some tough times. Basically, this money, there's no administration fees. It's all volunteer. Families send an email to our group telling us what happened to them. I'm not on the board. I'm not involved in that part of that. I just jump in the water and freeze. But this is a really cool thing that we've been doing as a company. This will be our 3rd year. Jack, Brett, and I will jump into the icy waters of Lake Michigan at Oak Street Beach, for those of you who know Chicago, on January 24th to try to raise some donations that will hopefully help change these people's lives that just have had some bad luck. You can request more information via the contact tab at Asbury Research, like everything else. Or here's our little graphic. You could Google Chicago Polar Plunge fundraiser and look for Asbury Research Arctic Aid. That's the name of our little group. Thanks for listening to that. This is important to us. This gives us a way to give back through Asbury Research. Our next Following the Money podcast is tentatively scheduled 2 weeks from today on Sunday, January the 25th, hopefully as the Bears are on their way to the Super Bowl. I hope to see you then. In the meantime, if you have any questions or want any more info on our research or managed account services, you can contact us via the contact tab at asburyresearch.com. See you in 2 weeks, and make sure you like and subscribe. Thanks for listening.